Most people will hear what I'm about to say and immediately reject it. Not because it's wrong, but because accepting it forces you to question everything you've been told about how the system works. And once you see it, you can't unsee it. That's the problem. Because the entire structure depends on one thing: belief. Not facts, not numbers, belief. As long as people believe the system is stable, the system stays stable. The moment that belief cracks, even slightly, everything starts to move in ways that can't be controlled. Turn on the news and you'll hear the same calm, controlled narrative repeated over and over again. Growth is steady. Inflation is easing. The job market is resilient. The worst is behind us. It sounds reassuring. It's designed to, but what they don't tell you is that the data holding that story together is starting to fracture in ways that are becoming harder to hide. Let's start with something simple, something that sounds almost abstract until you really think about it. $39 trillion. That is the current national debt of the United States. Not over decades, not over generations, right now. And numbers that large have a strange effect on the human brain. They stop feeling real. But this one is real. And more importantly, it is accelerating at a speed that should make you uncomfortable. 5 months. That's how long it took to go from 38 trillion to 39 trillion. That means every single day, over $6 billion is being added to the total. Every hour, roughly 250 million. Every minute, over 4 million. While you were doing anything today, working, scrolling, eating, sleeping, the number kept climbing. Now here's where it becomes dangerous. People will tell you debt doesn't matter. Countries borrow. It's normal. And up to a point, that's true. But what they leave out is the cost of carrying that debt. Because debt itself isn't the problem. Interest is. For the first time in the entire history of the United States, the government spent over $1 trillion in a single year just on interest payments. Not infrastructure, not healthcare, not defense, just interest. Money paid for the privilege of having borrowed too much. Think about that for a second. $1 trillion disappeared and nothing was built, nothing improved, nothing changed. It simply serviced the past. And it's not slowing down. Just a few years ago, that number was around 345 billion. It has nearly tripled in 5 years, and projections show it doubling again within the next decade. This is no longer a background issue. It is becoming the system. Because once interest becomes one of the largest expenses in a government's budget, everything else starts competing for what's left. And eventually, there isn't enough left. But here's the part that almost nobody explains clearly. The system doesn't collapse the moment the numbers look bad. It collapses when the illusion breaks. And right now, that illusion is still holding, barely, because of a few key mechanisms that are propping everything up. The first one is something you've probably heard about nonstop: artificial intelligence. It's real, it's powerful, and it's attracting enormous amounts of money. Hundreds of billions of dollars are being poured into it. Data centers, chips, infrastructure, everything needed to build the next technological wave. On paper, this looks like growth. Massive investment flows into GDP calculations, and suddenly the economy appears stronger than it actually is. Headlines report solid growth numbers, and the narrative stays intact. But there's a detail buried underneath that changes the entire picture. A significant portion of that spending is going overseas. The hardware, the components, the manufacturing, much of it is not happening domestically. And when you adjust for that, the real contribution to the local economy drops sharply. In other words, the number looks big, but the impact is smaller than it appears. The illusion holds, but it's thinner than people realize. The second mechanism is even more subtle: trade distortion. At the beginning of 2025, companies rushed to import goods before tariffs kicked in. That surge made economic data look weaker at first because imports count against GDP. Then, once tariffs were in place and imports dropped, the same economy suddenly looked stronger. Nothing fundamentally changed. The activity shifted, the timing shifted, but the underlying reality stayed the same. Yet the numbers told a completely different story depending on when you looked. And this is how the system maintains the appearance of stability. Not by fixing the underlying issues, but by shifting how they are measured. The third signal is where things start getting harder to ignore. Growth itself is slowing. What once looked like steady expansion is now beginning to stall. And when growth slows in a system carrying this much debt, the pressure builds quickly. because debt requires growth to remain manageable. Without it, the entire structure starts tightening. Now, this is where it stops being abstract and starts becoming personal, because economies don't exist in spreadsheets. They exist in people's lives. Household debt has reached record levels. Credit card balances are at all-time highs. And what makes this different from previous cycles is not just how much people owe, but why they owe it. More than half of people carrying credit card balances are not spending on luxury or excess. They are covering essentials, food, utilities, basic survival, and they are doing it at interest rates that quietly compound in the background. What starts as a small gap between income and expenses slowly turns into something much larger, a weight that grows over time. At the same time, another pressure point has reappeared. Student loans. For a brief period, the system paused. Payments were delayed, obligations were softened. But once those protections ended, the numbers snapped back violently. Delinquency rates surged at a speed that caught even analysts off guard. Millions of borrowers suddenly found themselves behind. And once that starts, it becomes very difficult to reverse. Because falling behind on one obligation often leads to falling behind on others. And that's how financial stress spreads. Now look at the job market, the one piece of the economy that is supposed to anchor everything else. On the surface, it still looks stable. Unemployment is not spiking dramatically. Layoffs are not exploding. But underneath that surface, something more subtle is happening. Hiring is slowing. In some areas, it has almost stopped. This creates a strange situation where the system looks stable, but it's no longer growing in a healthy way. People aren't losing jobs in massive waves, but they're also not finding new opportunities at the same pace. And when that happens, mobility disappears. People stay where they are, even if it's not ideal, because the risk of moving becomes too high. For younger workers, this becomes even more pronounced. Entering the workforce during a slowdown creates long-term effects. It shapes income, opportunities, and stability for years. And all of this feeds into something that doesn't always show up immediately in hard data, but is incredibly powerful: sentiment. Because once people start feeling uncertain, they behave differently. They spend less. They save more if they can. They delay decisions. And when enough people do that at the same time, it becomes self-reinforcing. Now here's where the system becomes fragile. The economy is not collapsing right now. That's not what this is. What's happening is pressure is building across multiple layers at the same time. Government debt is expanding rapidly. Interest costs are consuming more resources. Households are stretched. Growth is slowing. Hiring is weakening. Sentiment is deteriorating. Each of these on its own is manageable. Together they create something else entirely. Because systems don't break from one problem. They break when multiple pressures align in a way that leaves no room to absorb shock. And right now, that room is shrinking. The last time something like this happened, there was still flexibility. There was still capacity to respond aggressively. But today, that capacity is far more limited. Which means when the next real stress event hits, whatever form it takes, the response may not be as effective as people expect. And that's the part nobody wants to talk about openly. Because as long as the system appears stable, confidence holds. And as long as confidence holds, the system continues. But the moment that confidence starts to slip, even slightly, everything begins to change. And the truth is, that shift may have already started. And this is where everything starts to move from pressure into outcome. Because systems like this don't just break randomly. They resolve in very specific ways. Not one outcome, not one clean ending, but a set of paths that all lead to the same place, just at different speeds, with different consequences. And right now, there are 3 paths forming. 3 ways this situation can unfold. 3 endings that are already beginning to take shape beneath the surface. The first is the slow erosion. The one that almost nobody notices until it has already done its damage. This is the path where nothing dramatic happens overnight. No crash, no sudden collapse, no moment that dominates headlines. Instead, the value of money quietly declines over time. Purchasing power slips, prices adjust. Wages try to keep up but never quite do. On paper, everything looks functional. The system continues. People go to work, markets open and close, governments operate, but beneath that normality, something is being lost. You start to feel it in small ways at first. Groceries cost more than they should. Rent feels heavier than it used to. Saving becomes harder, even when income increases. The numbers say you're stable, but your reality says something else. And this is how silent devaluation works. It doesn't take everything at once. It takes a little consistently over time. What makes this path so powerful is that it doesn't trigger panic. It doesn't force immediate reaction. People adapt. They cut back. They adjust expectations. They normalize the change. But over years, the cumulative effect is enormous. Because if the value of money is slowly declining while debt continues to expand, the system effectively transfers pressure away from the borrower and onto everyone holding that currency. It's subtle. It's controlled. And historically, it's one of the most common ways heavily indebted systems resolve themselves. But there's a limit to how far this can go before people begin to notice in a more serious way. Because once everyday life becomes noticeably harder despite working just as much, something shifts psychologically. And that leads into the second path. The second path is instability. Not a quiet erosion, but a visible fracture. This is where confidence starts to weaken faster than the system can manage. Markets become volatile. Policy responses become more aggressive. Signals become inconsistent. You start seeing sharp movements instead of gradual ones. Prices jump unpredictably. Interest rates move in ways that create pressure in unexpected places. Businesses hesitate. Consumers pull back more aggressively. And most importantly, narratives begin to break. Because once people stop fully trusting the story they've been told, they start searching for alternatives. They question decisions. They react more quickly to negative information. This is where small events can trigger outsized reactions. A policy change that would have gone unnoticed years ago suddenly causes panic. A weak economic report creates a chain reaction. A shift in global alignment changes how money flows across borders. And in this environment, the system becomes reactive instead of stable. Now here's the critical part. Instability doesn't mean immediate collapse. In fact, it can last for a long time. It can come in waves. Periods of calm followed by sharp disruptions. But each wave leaves the system slightly weaker than before. Because volatility erodes confidence. And confidence is the foundation holding everything together. And then there is the third path. The one that people dismiss right up until it happens. The rapid reset. This is the scenario where pressures don't release gradually. They don't unfold over years. They compress. They build, and then something triggers a sudden shift. It could be a financial event. It could be geopolitical. It could be something nobody is fully anticipating right now. But when it happens, it forces a response that changes the structure of the system itself. In this scenario, things move fast. Policies that would have taken years get implemented in weeks. Markets react instantly. Liquidity moves rapidly. And decisions are made under pressure rather than control. This is where you see sudden repricing. Assets shift. Currencies move. Systems get restructured. And for people watching from the outside, it feels like it came out of nowhere. But it never actually does, because all three of these paths are not separate. They overlap, they interact, they build on each other. A slow erosion can turn into instability. Instability can trigger a rapid reset. And after a reset, the system often returns to slow erosion again. It's a cycle. And right now, we are somewhere in the early to middle stages of that cycle. The reason this matters is not to predict an exact outcome or a specific date. That's not how systems like this work. The reason it matters is because positioning yourself inside this kind of environment requires awareness. Because the biggest risk is not the event itself. It's being unprepared for the direction things are already moving. Now think about everything we've already talked about. Rising debt that is accelerating, not stabilizing. Interest costs that are consuming more and more of the system's resources. Households stretched to their limits. A job market that is no longer expanding in a meaningful way. Growth that is slowing while the burden remains. These are not isolated signals. They are connected. And when multiple connected systems start showing stress at the same time, the probability of a shift increases. This is why major institutions are quietly adjusting their expectations. Not publicly sounding alarms, but internally preparing for scenarios that look very different from the optimistic narrative presented on the surface. Because they understand something important. The system doesn't need to collapse to change dramatically. It only needs to reach a point where the current trajectory is no longer sustainable. And once that point is reached, change becomes unavoidable. Now here's the part that most people underestimate: human behavior. Because economics is not just numbers. It's decisions. It's reactions. It's psychology. When enough people begin to feel uncertain, they change how they act. And when behavior changes at scale, outcomes change. If people start pulling back spending, growth slows further. If businesses anticipate weaker demand, they reduce hiring. If investors sense instability, they move capital differently. Each reaction reinforces the next. And suddenly, what started as a possibility becomes a direction. This is why sentiment matters as much as data, because sentiment can accelerate reality. And right now, sentiment is shifting, not collapsing, not panicking, but changing. You can see it in how people talk about money, how they think about the future, how they approach risk. There is a growing sense that something is off. Not broken yet, but not right either. And that feeling is often the earliest signal, because by the time the data fully confirms it, the move has already begun. So the real question is not which of these three paths will happen. The real question is which one you are prepared for, because each path rewards different behavior and punishes different assumptions. And most people, without realizing it, are positioned for a version of the future that may no longer exist. That's the risk, not the collapse itself, but the mismatch between expectation and reality. Because systems can change faster than people adapt. And when they do, the gap between those who are prepared and those who are not becomes very visible, very quickly. Right now, nothing feels urgent on the surface. Life continues. Markets function. The system holds. But underneath, the pressure is real. The signals are there. And the direction is forming. The only thing left is time. And when time runs out, it doesn't send a warning. It just moves. Now you know